So this is our tech stack when we underwrite for Monday.com, our deal flow, task management, all in Monday. Is it a highly decked out version of Monday? We have about 80 some people using Monday, and we manage our investor relations, our underwriting workflow, and the notes and everything else. That becomes a database for us. For initial underwriting and the deal analysis, we use RedIQ. The license of RedIQ is upwards of $25,000 a year. We invested that to get ahead, to make sure that we're underwriting systematically. We come ahead of this and others. And also what it did is it allowed the velocity of deal underwriting that we do. We underwrite 30 deals a week almost. And so we underwrote this year almost 1,200 deals. Unless you have a deal and a tool, it's tough. So if you're in LP investors and your GP team is looking at 3 deals a month, then what's the likelihood of striking a deal that makes sense, right? So that's one thing. And then we also use synthesis for back of the envelope and detail underwriting. There's a between RedIQ synthesis, we underwrite most of the deals. Then we have a contract to close, and we have our own proprietary operational dashboard that we run all the assets. So why? We have over 15 assets, about 6 different property management software, and we don't have time to download data, spend half a day to create a report, then come and try to understand the report, and then come back and try to make a decision, right? It just doesn't work at a velocity. So what we did, we have a master mapping, we force feed everything into our dashboard. So our ranking system cuts all the data the same way. We have full-time employees, they're running those on a Power BI for us. We have two full-time analysts that are running the RedIQ synthesis for us. And every time there's a project, we assign somebody individual, who focuses on the contract to close. That's also because we continuously ask the question, number one, do you have what you need to get started? And number two, do you have what it takes to compete in the marketplace, right? Because there are lots of other syndicators, there are lots of other operators, especially the number two, it's a crucial. This applies for you as an LP perspective, and you need to look at this, the sponsor team very critically and ask the question, do they have what they need to get started? And also, do they have what it takes to compete? Right? If you don't have the right tools and a process for you to finding a deal, it's very unlikely. And if you do, then you got to know something in the location. So just if you look at from that perspective, it gets a little bit more meaningful, analytical way of looking at it. Now, the other one, sometime we'll come back. If you're an LP, just having templates and access to videos will not get you in the winning cycle. You flipped a house, that's great. You made that $50,000. It does not mean you can go compete on a $5 million property or $3 million property. You cannot. It's just different. Riding a bicycle different than a tricycle, different than a car, different than a semi, right? And every single one takes time to learn. So number one is very critical. Oftentimes we think, yeah, YouTube University, 5 templates, I know how to underwrite. Yes, you know how to know the Excel modeling, but not the number that goes in it, right? Number two, we always say life is unfair, so is commercial real estate. So number three is how many unfair advantages you can be on your side, right? I mean, it is real. I have assets I am losing, and I remember there's a gentleman that I met year before last. Him and I were competing for every single asset on the multifamily side. I'm losing to him, and then I had to call him. I was like, "Hey, how do you underwrite? And why am I losing? Why am I so far away from your offer versus my offer?" Because we knew. Then I started talking. Then we started competing. His thing was, sure, there are 3 kinds of money. I was like, what does that mean? I mean, what does that mean? He was like, one kind of money trying to make a living. And that means you need the most amount of return, because you're trying to make a living, right? And number two is trying to make a side gig money, right? You're not looking for the max return. You're not looking for the lowest return, but you're looking for decent return, right? Above the market. And third kind of money is we call it some kind of I would say value protection money, which is I already made it. I'm here to protect my money, make sure I don't lose it. My man, he was talking about his money, it's on a value protection mode. So he is willing to pay a much higher price because his expected rate of return is much lower than I am. When Massive Capital underwrites it, on the LP side, is 17 to 20% IRR on a Class C, 15 to 17, 18% IRR on a Class A. When he underwrites, he looks at 12 to 14% IRR on a Class A. So 12 to 14 or say 15 to 17, that 3% on a $20 million deal, a $30 million deal, it's a big spread. And his dad, so he will always remind me, life is unfair. Just get as many unfairness on your side. But the lastly is like find your team. Without a team, you're not gonna be able to compete. Without a team, you're not gonna have increase the likelihood of winning, which is getting a return that you're looking for. Right. So we always have that in our mind. We always do that when we look at our process. We ask the same thing that as an LP, what is it that we're looking for? What is the unfair advantage that we can put on our side so we can compete on the market, right? Gotta have something. So let's look at some of the numbers, right? So this is the older slide. I kind of throttled down the number. So massive capital side, just us, just the team. We have done more than 300, I think it's almost 400 assets across all verticals: land, single family, industrial, retail, single family development, and multifamily. So whenever we take a look at it, our position has been that just like your stock portfolio, you offset the risk from the different domain. Same thing, we should have it within the real estate, because each of those categories, they will behave differently based on the economic cycle. And same thing for us, we want to have that ready for investors as well. And we saw that the whole thing played out during the down cycle the last couple of years, that if someone's strategy was just pure multifamily for a certain asset class, for a certain location turn, you are in a deep water. But versus having different other asset classes, so you can offset each other, so you can build a portfolio that is somewhat of a risk adjusted return. And that's where, so when we look at it, it's there. So you can go back and ask your LPs, hey, how many deals you have done personally? Right? What type of investment you have done? And where have you done it? Right? So we looked at that perspective. And if then we ask the question, all the deals that have done, is it a meaningful size? It's not the return. Return is there, right? When the market rides, everybody rides with the market. But really, have you done one deal? Have you done 10 deals? If you have done 400 transactions, that's a lot of battle scars, right? We might not look like, but at least we know what a bad deal looks like, right? So that's where we at from our side of it. So underwriting, it's a very crucial when we look at it. So have a base level underwriting. Then we underwrite everything from the LP perspective. That is it making sense from the LPs, right? Because as an LP, we have an option to go to bank, put down our money as a CD, get 5%. That's like risk-free money for $100,000, right? After that, there is some risk associated with it. So that's there. So the cheapest thing I can get, or the most, either I can go stock market. If I don't like stock market, I don't want to take an equity risk, then I can go to a bank, put down the money, and it can get a 5% CD. I'm just using some numbers. Versus, do we have any other options for the same person for a better risk or for lower risk? Can we provide a higher return? Right. So we are continuously looking out for return from the LP perspective, and you'll see some of the products is going to come up next couple of weeks based on that. Then we look at a GP perspective, right? This is a very different way of looking at it. Like, I'll give an example from the massive side. We don't recommend anybody get into a deal where you have 90-10 split, 85-15 split. Even for the LP perspective, even though you get that 90% or even get the 85%. And to us, that's a very misaligned incentive program for GPs to work for the LPs, right? Ultimately, GPs are working for LPs, right? What it means is that if you have a deal, 90% goes to the LPs and 10% goes to general partners, and you have 4 or 5 partners, they're going to work for 5 years. And then you look at the total return, divide by 5, divide by number of partners, it's not much. What it means is that they have to do more projects. What it means that they have to take the time out from that project to somewhere else. So if the project is not meaningful, it's very one-sided. So from the LP perspective, we always say a good, healthy project, you'll see 70-30. And that's a good starting point, because it's tough to make a deal at 7. It's really, really tough to make a deal at 70-30. But if you do get it, it's a healthy deal where GPs are well taken care of, and they also take care of the LPs as you go, right? Because ultimately LPs are hiring the GPs, right? The question is, do you want to hire a CEO, a team of CEO, and are the high caliber CEO, right? They are the C-level team. It's not cheap and free, right? You get a version of it if you go. So that's there. We look at from a GP perspective, and one thing we use is the return on effort. We can create a value But if the effort is way too much to create the value, sometimes it's just not worth the trouble. So most of the time, our deals, we take a look at that kind of fall short is from the return on effort perspective. That even though we can create value, underwrite well, it's too much risk, too many things we have to go through, get to the value. We say, well, it does make sense. And then we adjust the school of hard knocks, what we call it, right? So Trevor is laughing.
Somebody caught your error on math on multifamily. 20 and 30 equals 70.
Oh, sorry, my bad. I had some other. Okay, I apologize.
It's okay.
Take it, my bad. Okay.
Always somebody finds it.
Hey, that's good.
Keep an eye
someone
on
write it down. Okay.
it.
Thank you. I was writing the number down and kind of throttle it down wherever was possible, but then I got caught on that one. Okay, thank you for it. Really appreciate it. So going back, school of hard knocks, right? Why we say that? There's oftentimes you'll see on the multifamily side, we said, hey, if there is any value add, and just because I do a value add, something will show up, and just because I do good marketing, I do my rehab, tenants will come. Makes sense on Excel file. It's always a hockey stick. But school of hard knocks will teach you not all the time is hockey stick. It can allow some breathing room, right? Some slippage has to happen. So we do the myth versus reality. We always keep that in mind. And we have our own database to understand, underwrite this. And that's how we manage ours. And then we have Realty One. Realty One has been in business for 40 plus years. If a team has survived for 40 plus years, they have a lot of wisdom, right? So there's a lot of learning. So when we try to bring a deal, we try to bring it together and we say, hey, it makes sense. This is how we underwrite it. This is how we go. And I know you'll see our goal is we try hard not to do a deal. We try hard to kill a deal. And if we can't kill a deal, then it's worth going. We don't start from the perspective we want to do a deal. And then that gets really skewed because if I try to look at from the glass is half full, then I don't know my points of failures. Versus if I say, hey, if we don't want to do the deal and see how it fails, then we can come back and say, if I fix those things, it's doable. If we fix those things, it's doable. That's how we take a look. That's how we take a look at it. All right. So last slide that I have is the learning curve. And learning curve is real. It's for everybody. So all in all, if you put the whole team ready, get your strategy, and the structure will follow your strategy on the top right. Then get the people on the bus, right? You got to have your investment hypothesis. Then you have to look for the teams that matches your hypothesis, and then you kind of go for the learning curve. And then what we call it, we all can learn, but you don't want to learn. Learning is expensive sometimes. Shorten the learning time. Learning is freaking expensive. It's like I am from Bangladesh. I got a lot of families. There are physicians, doctors. We call it doctor syndrome, right? I can do it, which is true. We got a bunch of engineers and doctors running the whole houses, but which is true. I can do it. But by the time I get done with it, which is where I'm good at it, it takes years, right? 5, 6, 7, 8 years to get something really good at it. And by that time, so many people made so much money and so many mistakes we made for it. So learning is great, but always remember learning is extremely expensive. And higher the dollar figure, learning equals to money. And so you just don't want to be on the money. So sometimes it's how, sometimes it's who. Who, not how, is very important as you go through both from the LP side and also from the sponsor side, right? And that's our little thing as we kind of go through. Everything has a definition. Solve backwards. There is no forward looking, right? What I meant to say is that when you get a job, when you go to school, obviously, yeah, I'm gonna go to school and get a degree. Once you get a degree, I'll get a job. Once I get a job, I'll work up in the company to be somewhere else. But you're continuously right sizing. Versus if you could flip it and you say, hey, you know what? I am crazy, but I want to work for top 5 companies for a certain type of role, and I'll back it in. All of a sudden, you'll see what classes you have to take, what grades you got to make, what interns you got to have, who you got to go talk to, what kind of a skill that you need. It gets easier, right? That's what we call it, solve backwards and also personalize your own learning curve, make informed choices, invest in tools. And if you are LP, you're looking at lots of deals coming up, have a spreadsheet that puts all the deals side by side so you can compare the deals or ask questions, participate, right? The best way to shorten your life cycle is you sit through 10 different webinars in 2 months and you'll figure out just by listening to others what we talk about, right? It's not that complicated, but you got to put in some time and then establish a timeline and get mentors wherever possible, right? Mentors sometimes expensive, but sometimes they make a lot of money. All right, so going back, I would say here, so 2025 preparation, we talked about it, all it is. I'll give you guys a homework for us. You have two options: be actively passive or be really active, right? You're here, took an hour from your family life or your life, giving that to us, and you have to get some benefit out of it. So going all of the things that we talked about, ask yourself those things, which bucket do you go sit, right? And if you want to be passive, this is your play. I give you an Excel and a file where you can build your portfolio this way. Look at all the asset classes, asset types, put some location, put some years, take a snapshot on the top left, put your hypothesis, then we kind of go. But ideally, ask yourself, you want to be actively passive or you want to be really active, right? This is where we sit in. We're active. We're continuously doing all these things full time. Our whole 16 people team, all they do here, actively passive is you spend 2 hours, maybe 1 hour, maybe 5 hours a week, 10 hours a week, looking at sponsors as you go. Then wrap up. Again, go if you're actively passive and you don't know which way to go, which is fine. We got Trevor, he gave you his link. So we have 2 projects. Go learn those projects. First project is the depreciation and cash flow I was mentioning before. It's a 5 years the whole time, business plan, whatever it is, right? And the other one is the high velocity total returns, 3 years the whole time. It's a different type of return and then different type of timeline as you kind of go. But the point is take action. Don't have to invest, but still talk to Trevor or talk to one of our team, get that process kicking on your side. And if you want to be really active, there we go. We have a Centurion Expo coming up. This is invite only for 50-ish people. We spend 3 days and we go through all the asset classes that we invest in: land, new development, flex space, self-storage, multifamily, and retail centers, all of them. We spend 3 days for 45, 50 people, invite only. I think Olivia, it's gonna, if you go over there and schedule 15 minutes call with Olivia, she'll sit down, quickly run down some, strategy or investment hypothesis, and she can really help you by saying that, okay, if this is a good fit or it's not a good fit, or it's not a good fit right now, it's a good fit later down the way. And if you want to be passive, just reach out to one of us and get into a practice of what does it feel like to be active. And once you get into our database, which you guys are, you'll get the emails for the webinars, you'll get the webinars for the bus tours and all this other stuff, right? And last one, I really like this one, which is investing is not about it's all about the managing risk, not avoiding it. Every single thing has a risk. There's a risk of breathing, right? So it's all about managing it, not avoiding it. And the second one, we always say, look, I don't have to be the best. We just have to be disciplined. We just have to be disciplined. It's not about being the best. Just stay steady, go for the ones and twos all the time, and you're gonna build a muscle where when you see the weak ball, and you're gonna get the home run right away. So, having said all this, I